And only when the first 75 basis point hike came, it started sort of turning very much. So it has been quite an interesting year in that sense, with a lot of dimensions and a lot of sort of nuances.
How is everyone positioned? Maybe what did change in a portfolio, maybe the last couple of, the last year?
We are cautious on equity, so our equity exposure is lower than the historical, average, I would say. We are more cautious on duration as well. We have a broad allocation in most of our portfolios. It's always a question of target and investment strategy of each single fund, but usually we tend to diversify across equity, fixed income. As I mentioned, liquid alternatives. Commodities plays a more important role since last year, so it was not very important the years before. Gold probably was invested, but commodities really increased their importance. Also based on the energy transition, many commodities are required for this energy transition. So that is more important this year. And what is also really key is the sub-asset class allocation. So not only equity, we don't just invest globally in equity, we think about what is an ideal regional allocation, are there any thematics that look attractive at the moment, so that is sub-asset class allocation on equity side, and the same on the fixed income side. Fixed income doesn't equal fixed income. There are so many dimensions to think about.
It's very much in line with that. So over the course of the year, we had been careful with equities, so we turned rather cautious. So over the summer period, we were quite cautious about bond markets and the potential for yields to rise. But very much as you said, it was a year that was very much dominated by what kind of equities to own. When you think of it, the overall equity market went down, but value segments within the equity market went up, regardless of what the Fed did. And only when the first 75 basis point hike came, it started sort of turning very much. So it has been quite an interesting year in that sense, with a lot of dimensions and a lot of sort of nuances. But overall, we remain careful with regards to our allocation to bonds, cautious on the bond side, and within equities, we are also rather careful.
We have the luxury, because of the defensive parts of our portfolio held up that well, that we can go on the offense or slightly on the offense. So we're adding to the equity exposure, but very slowly and very gradually in different parts of the market. What we wouldn't do is buy in long duration of any kind. So, for example, consumer staples or the usual tech darlings in the world in the last years. So we would shy away from that. But we're looking in niches, basically. If it's emerging markets, for example, in the very small ones, frontier markets, there are some interesting things left there. At least we think so. And we would go away from very large US equity exposure, because it's still very expensive, and if the tightening continues, we think there is still a lot of downside, or at least right now from our point of view there is downside left, and but we change our view quickly if markets change, and if they move to the downside quickly, we might even buy US investments next month, but not right now and not at these prices.
We're very similar. We're very agile, so we shift our positions a lot. It's all top down, playing in futures in about 140 markets. So I guess the big things this year have been long a lot of the commodities, like in energy early on, that you've then taken those positions off and don't have much now. Very much short at the short end in fixed income, expecting central banks to have to sort of catch up and be more aggressive. We've made a lot of money in yield curve slope changes, so recognizing that's been the dominant thing at one end, but we've been long and short, flipping in and out at the long end. In FX, we've been long the dollar, has probably been the biggest, most successful trade. And then in equities, the big thing has been short most of the second quarter. So that's been very helpful, and then that's continued into the third. But in and out more in the third quarter.